So now we're going to talk about the allowance method. So again, we are going to use the allowance method when we are a publicly traded corporation and we're following GAAP, those generally accepted accounting principles. So as you can see by the journal entry that's up on the board, we still debit bad debt expense. So it doesn't matter what method we use to account for bad debt expense gets debited every time we, decide that we're writing off bad debt or, estimating bad debt. Okay, so bad debt expense still gets debited. But, when we use the direct write-off method, those journal entries could be any time throughout the year. We decide that an account is uncollectible, we write it off. When we use allowance methods, these estimates are going in at the end of the fiscal year. So this is an adjusting entry, which I know everyone loves adjusting entries. But I think sometimes in this chapter it kind of helps you more from what, when you learned adjusting entries, the light bulb kind of goes off a little bit more when we talk about it because it's more applicable, I think. You understand the concept a little bit more. So here it says we're at the end of our accounting period, Extone Company. They have an accounts receivable balance of $200,000. So at the end of the year, and if you remember, accounts receivable is a permanent account. So that $200,000 balance, some of that could be from last year or this year. It's a revolving, it just keeps going, right? We just keep adding to it. So it is kind of important to keep that in mind. So accounts receivable is a permanent account. That $200,000 could be from this year, last year, whenever. But they've estimated that a total of $30,000 of that will be uncollectible. So we'll talk about in a little bit how to estimate those amounts. So right now we're just looking at kind of the journal entry structure. So again, this is an adjusting entry. So we're at the end of the accounting period. We're on the last day, December 31st. And we've said out of all the accounts receivable we have to this point, we're estimating $30,000 is uncollectible. So now we're still debiting bad debt expense, but instead of crediting specific accounts, because we don't know which accounts we're going to write off, which accounts are bad, we're just estimating, we're going to use this allowance for doubtful accounts. Okay? So allowance for doubtful accounts is a new account, and it's what we call a contra asset. Does anyone remember what contra meant?
How is that contra asset? Because contra is the physical properties of the company. This is more of a...
Contra it's not. Contra just means opposite, actually. Yeah, so that's why it gets a little confusing. Yeah, so contra, when we talk about a contra account, we just mean that it does the opposite of a normal asset. So a normal asset increases on the debit side. A contra asset normally increases on the credit side. Okay. Trying to think. Other contra assets we used were like the, my mind just went right, depreciation, accumulated depreciation. Mm-hmm. And there was another one in merchandise inventory. Like when we dealt with like sales, returns, and allowances was also like a contra sales account. I have to pull from the recesses, right? So yeah, allowance for doubtful accounts is what we call a contra asset account because its normal increasing side is actually on the credit side. So what it does is instead of decreasing accounts receivable directly, we're using this allowance for doubtful accounts. So allowance for doubtful accounts is indirectly decreasing accounts receivable. Accounts receivable has a debit balance. This allowance for doubtful accounts is affecting that accounts receivable.
Is that bottom, since it says uncollectible accounts estimate, just telling you what that account is?
Yeah, that's just a journal entry explanation. So we don't usually do those in Cengage, but in a typical journal, you would see like the debit, credit, and then some explanation. It's a good question. So that's just an explanation of what the journal entry is. So you won't have to put those in ever in Cengage, which is nice, right? A lot of extra typing. So we debit bad debt expense and we credit allowance for doubtful accounts. Anytime we use an allowance method to do an estimate, that's the debit and credit. We debit bad debt expense and we credit allowance for doubtful accounts. So again, I kind of mentioned this before. The reason these adjustments are so important, if you remember when we did adjustments back in chapter 3, is adjustments are all adjustments to either like income statement accounts, like revenues or expenses. And an adjustment always deals with either a revenue or an expense account. So in this case, we're dealing with an expense. So it's so important to log these adjusting entries, because if we don't recognize this $30,000 of bad debt expense, again, our net income is going to be overstated. Because if you remember on your income statement, you list all your revenues and you list all of your expenses. Revenues minus expenses equal net income. So when you don't recognize the expense, your income is overstated or too high, which honestly means you're going to be paying more taxes. So there's that side of it too. But obviously you're going to also look like you've been more successful and made more money than you actually physically have. And that's an accounting principle problem. Okay, so we have to be, accurate as we can possibly be. It's an estimate, but at least we're not just, over here assuming we're going to collect 100%. And then the difference on your balance sheet is now we're going to see what we call net realizable value of the receivables. So basically what it'll look like in T accounts, you're going to have accounts receivable. And it had, a $200,000 balance. And that was a debit balance. And then over here, you have allowance for doubtful accounts. I'm going to do for DA for short, doubtful accounts. We're going to log that 30,000 credit right here. That was an adjusting entry. So that's where they're getting this net realizable value. They're taking the accounts receivable of 200,000 minus this 30,000 credit. So we really think we'll really be able to collect 170,000 of accounts receivable. So the net realizable value on the balance sheet will be the 170,000. And then our income statement will have that bad debt expense, so it'll bring down our net income by 30,000. Does that make sense?
200,000.
The 200,000 was how much they told us we had in accounts receivable at the end of the year. We went back one slide. So we had 200,000 in accounts receivable. Now we wrote off 30,000 as uncollectible. So we just subtract and we find our net realizable value is 170,000. Any questions on that? And again, that's kind of the most important concept to understand, is that if we don't do these adjusting entries, how it's affecting us long term. Because if we keep doing that year after year, we're going to look like we have all of this income and all of this money. Where's the money? We don't have the money. That's a problem. And it's going to affect our viability moving forward. Any questions? You guys good on that so far? So we're going to talk about one more little thing here on the allowance method, and then we'll do another example while we're on it. The thing is, we're estimating, right? We've estimated 30,000 of that 200,000 was uncollectible. Well, all of those people are still there on accounts receivable. All that's technically still in accounts receivable. So eventually, even under the allowance method, we're going to want to do away with specific accounts. We still have maybe that DL Ross or whatever his name was that didn't pay, So we still can write off specific accounts under the allowance method. Okay. So we just take it out of that allowance. So if we determine someone has a $5,000 bill and it's not collectible, we're just going to take that $5,000 out of this because we've already estimated some of it. So now we're saying, well, of this $30,000 that we estimated, $5,000 of that came from DL Ross. Okay, so we're going to debit allowance for doubtful accounts and credit DL Ross's account
So
receivable.
this is the whole thing, not just a single account.
Correct. Yeah, this is the whole accounts receivable. So then when we actually determine that a specific customer isn't going to pay, we're going to pull it out of that allowance. And we'll do that throughout the next year. So now we're in, like, say we're in 2020. I can't believe this next year is going to be 2020. It sounds a lot. So now we're in 2020 and we're looking at, okay, now this customer's not going to pay or this customer isn't going to pay. So we're going to take that out of that estimate because we estimated $30,000 was going to be unpaid. Now it's no longer an estimate, we're actually pulling direct accounts.
What do you do if you underestimate?
You'll
Or
readjust.
not underestimate, but overestimate.
Well, that's a great question. Either way, right? You could over or underestimate. So that's a good question. So this allowance for doubtful accounts, which we'll see here in a little bit, it can actually go to a debit balance or it can stay a credit balance. So it's kind of a weird, if we wrote off more accounts than we anticipated, we would go into the debit side. And then what we're going to do is deal with that at the end of the next year. So at the end of every year, we'll have to figure out, well, what's already in allowance for doubtful accounts and what do we need to do? So it'll make sense as we kind of go through it. But it is a good question.
Because the only question I have is like I can't think right now. If you're overestimated, instead of trying to do the matching principle, but you don't have the funds for it to match it for the next year, doesn't that show records off?
What happens is, since it is an estimation, so say we did, you say overestimated, right?
Yes, it's like actually like 40 pounds.
Okay, so we underestimated. So this would actually go into the debit balance, and then when we did our estimation at the end of the year, we would consider that and have to adjust. So we are adjusting this every year, if that makes sense. So this balance actually does matter when we do that adjustment. But yeah, we'll do examples of that because that's kind of where it gets a little tricky. A good question. So on this one, we have John Parker, $6,000 is written off. So again, we're going to debit allowance for doubtful accounts, so $6,000 here. And then we're really crediting John Parker, but it comes out of the accounts receivable for John Parker specifically. Okay, so we debit allowance for doubtful accounts. Of the $30,000 that we estimated, we think $6,000 of that comes from John Parker. So that's where we're actually taking it out of accounts receivable. Okay. So your net realizable value stays the same. When you take accounts receivable minus allowance for doubtful accounts, well, you've just said out of all the allowance we've made, 6,000 of that is John Parker. So your total amount that you think you're going to collect stays the same. Because now we have what, 194,000 balance minus 24,000. That's still 170,000. We're not changing what we think we'll collect. We're just identifying of this that we've estimated, we think 6,000 of it is going to be this John Parker. He's not the one that paid. Okay. And we just do this all throughout the year for every customer that we think isn't going to pay. Okay, so we could just we're going to keep debiting allowance for doubtful accounts. So if we did underestimate, this could end up having a debit balance. Or we could have underestimated or overestimated, sorry, and we could still have a credit balance. Very rarely do we do it perfectly. So usually when we go to do our adjusting entry the next year, allowance for doubtful accounts has a balance. It could be a debit or a credit. It's kind of a special account. You're not special. It's like what I call my kids. You're so special. So, let them take that as they will, right? Good, bad. And I kind of already talked, I just said all of that.
So that's 30,000 for the whole year?
Yes, yeah, that's an estimate of what we think we won't collect. Yeah, for the whole year.
And then this is where you pay.
This is actually saying, well, out of that 30,000 that we estimated as uncollectible, we think 6,000 of that comes from John Parker. Like we're saying he's not going to pay. So they show it as a bucket. It's kind of helpful, right? So we did an adjusting entry and we said, this is all the money we don't think we're going to see. And then as we write it off, that estimate gets smaller because now we've, written off specific accounts. Okay. And then we fill the bucket back up. And then we dump it out again. And this is just cyclical. Every year we do the same thing. We do an adjusting entry at the end of the year, and then the next year we debit allowance for doubtful accounts. A lot of accounting is cyclical. So here they're just showing you again, during the second year, Extone Company writes off $26,750 of uncollectible accounts, including the $6,000 of John Parker. Okay. So allowance for doubtful accounts will have a credit balance of $32.50. So what they're showing is they don't show every entry, but as we go through the year, we write off accounts and we just continue to write off. We have John Parker, then we may have that DL Ross, we have someone else. And we do this all throughout the year. And all total, we wrote off $26,750 directly.
So that's how much money we've actually written off. And that 30,000 is still an estimate.
Correct. Yeah. So at the end of the year, we still have $32.50. So we did overestimate, but just slightly. That was a pretty good.
Then you adjust that.
Yep. Did you have a question?
So you estimate that at the end of the year? So in a perfect world, everybody pays it off. Would that ever be zeroed out?
And yeah, in a perfect world, if everyone paid it off, you would still have the 30,000 balance sitting out there, that we would obviously have overestimated. And then
It could be out.
Yep. Any other questions? They're big concepts, right? It's a lot. Okay. Well, while we're dealing with just those examples, let's switch over to our Cengage practice. And you should be able to go to the next question. And we'll kind of look at this. So this one says journalize the transactions for Zippy Interiors Company. They use the allowance method, so that means they're GAAP compliant. They're probably a publicly traded corporation. So as you can see, we have the first journal entry is still a review. So sold merchandise on account to Old Town Cafe, $18,450. The cost of goods sold was $11,000. So what do I debit and credit to recognize that figure?
Accounts receivable sales.
Very good. Accounts receivable, Old Town Cafe. And we're going to credit sales for the full sale amount to $18,450. Okay, so accounts receivable debit and sales credit. And then what's the second journal entry for that? The cost. Yeah, we're going to debit cost of goods sold and credit inventory. Good. And that's for the $11,000 cost of goods sold. So we debit cost of goods sold and credit inventory. So again, those are just review. And let's see, on September 30th, it says we received $6,000 from Old Town Cafe, and we wrote off the remainder owed as uncollectible. Well, again, even though we're using an allowance method, we can still write off direct accounts. but it's going to come out of this allowance for doubtful accounts instead of bad debt, okay? So on September 30th, well, what do I do with the cash? We'll deal with that first. We debit it, right? So I'm gonna debit cash, $6,000. And then he still owes us, what, $12,450?
Yep.
18,450 minus 6,000. So that 12,450 he still owes us, we're writing off. With a write-off under the allowance method, instead of writing that, reversing it from bad debt, we're going to take it out of allowance for doubtful accounts.
So we don't do anything with that then?
Correct. We do not do anything with bad debt. And the reason for that is, at the end of last year, we already debited bad debt expense, $30,000, and credited allowance for doubtful accounts.
Okay, so it's kind of already there now, right?
Yeah. So we're going to debit allowance for doubtful accounts, just like we did here when John Parker didn't pay, okay? So when someone doesn't pay under an allowance method, we debit allowance for doubtful accounts. And then his whole accounts receivable will be credited, the 18,450. So Old Town Cafe accounts receivable gets credited for the cash amount and the amount we're writing off directly. So under the direct write-off method, this said bad debt expense, right? So your only difference is we're under an allowance method. So that direct write-off is coming out of allowance for doubtful accounts. Bad debt expense was still $30,000 from last year. That doesn't change, okay? So under the allowance method, at the end of each year, we're debiting bad debt expense for the total estimate. That's the only time we're debiting bad debt expense. That makes sense? So that just stays there.
So we're doing the 30,000 for everybody.
Mm-hmm. Yeah, that's just an estimate of all of our customers, everybody.
Everybody's gonna pay this stuff.
Yeah.
Will we ever have to come up with an estimate?
We will actually in the next little section, we will work on, they'll give you like percentages, and then we'll work on you'll calculate percentages. And there's different methods to come up with that allowance. Good question. So then the next two journal entries deal with now, of course, we wrote off Old Town Cafe. Now it's December 7th and Old Town Cafe paid us the $12,450. Again, we'll take the money. We just have to account for it. So it's really, we're just reversing the entry when we reinstate under the allowance method. It's the same idea. So here we're still debiting accounts receivable to reinstate that account, the $12,450. And we're going to credit allowance for doubtful accounts. So reinstating the account is still a reversal. We're just flipping this. And then when we collect on it, well, what would I debit and credit to show the collection of the money?
Cash.
Cash, very good. And what would I credit?
Accounts receivable.
Accounts receivable, perfect. So the collection stays the same. It's always a debit to cash and a credit to accounts receivable.
Would you say it's comparable to the petty cash?
Almost. I mean, with petty cash, you were like reimbursing
Yeah, we
it.
have to start and then we'll make sure we get back to whatever our
It's
estimate
kinda
is
similar.
basically like our petty cash that we're taking from. everything.
It is kind of a similar process. The only difference is with petty cash, you have a finite amount that you're getting to, whereas this, it could be different at the end.
Yeah.
But yes, it's kind of the same process. Any questions? Okay. You can check your work if you want to. Let's see. I'm going to go back to the PowerPoint. So, this was showing again like the whole year. So we started with that 30,000 estimate, and then throughout the year we wrote off specific customers. So at the end of the year, we still have a balance in that allowance for doubtful accounts. And you probably will, because again, it's not a perfect world where we'll be able to estimate exactly how much money, we're not going to see. So the important thing to understand at this point is allowance for doubtful accounts can have a credit balance like it does here. Or if we had written off maybe another account for $4,000, this would then have a debit balance. Okay, so allowance for doubtful accounts, before we adjust it, so it's an unadjusted balance, can have a credit or a debit account at the end of the year. Because we've just written off accounts. So in this case, we wrote off $26,750. But again, maybe we'd written off one more account for like $4,000, but we would have been beyond what we estimated. So allowance for doubtful accounts would have a debit balance at that point. So if we write off more than what we estimated, allowance for doubtful accounts can have a debit balance. So if we write off more than what we estimated, allowance for doubtful accounts can end up with a debit balance. That's why it's special, right? Because accounts receivable, debit balance, it's going to have a debit balance, right? Cash is generally going to have a debit balance. So this little guy here, allowance for doubtful accounts, is special because if we, our estimate is just that, it's an estimate. So we could be high or low, okay? So if we underestimated, we could end up with a debit balance here. And that's okay. It means, it doesn't matter. It just means our estimate was off. We were a little low. If we end up with a credit balance, that just means we, overestimated a little bit on what we would have uncollectible. So a debit balance means we underestimated, and a credit means we overestimated. Either way, it's fine. That's the end game. It's fine. So don't freak out if you see a debit balance there. Okay.
So that right there is an example of debit.
It is, yeah. I guess I should have looked ahead, right? Like, here it is, what I was talking about. So this is an example where, yes, we actually wrote off a total of $32,100 in uncollectibles throughout the year. So instead of like 26 something. So now we've gone beyond the 30,000. So allowance for doubtful accounts has a debit balance of 2,100. Bless you. Bless you. Okay. So that's an important concept to understand. Now, at the end of this year, when we do our adjusting entry, because we're going to still do another adjusting entry and estimate in this year how much was uncollectible, then that allowance for doubtful accounts will go back to a credit balance. So after we do an adjusting entry, allowance for doubtful accounts always has a credit balance at the end of the year, going into next year. Because we're going to do this every year. Super fun, right? And, we could, again, write off an account one year and then reinstate it and collect money the next. That's okay. Again, this allowance for doubtful accounts is a revolving account. So that's why we do this estimate, because accounts receivable is a permanent account. Allowance for doubtful accounts is a permanent account. Okay. So it's going to continue having a balance year after year. We already really just did those. We're good on that. We did the reinstating and paying, so we're good. So the next big part of when we're dealing with the allowance method is, well, where did they get that 30,000? You're just asking that, right? Well, do we do that estimation? We can't. Okay. So there are some ways in which we come up with that 30,000. It's not just an arbitrary number. We don't just pull it out of the clouds. Okay. So we have to get to this estimate of what we're writing off. So how do we get there? Well, again, it is an estimate. It's not a guesstimate. It's truly an estimate. So we look at last year. Well, what did we have uncollectible last year and the year before that? Then we look at sales. Are our sales the same this year as they were last year? We look at economic indicators. When the economy's down or when small businesses are closing, do we have small business customers? Are they going to be able to pay their bill? These are all indicative. We don't know, right? Probably not. So, it's important. Is JCPenney or Sears one of our people that owe us? And they're like, so, and they're one of our clients, well, we might want to consider that. So, it's a weird economic time we're in, really, isn't it? Because our economy is actually doing good. It's pretty stable, but there's plenty of businesses in the retail industry that are not doing good. So, it's kind of a weird time. We won't get into the economics, though. You don't have to worry about that. The two methods used. We have two methods. We have a percent of sales method, which is the easy method. And then we have an analysis of the receivables. So there's two ways to estimate uncollectible accounts. We can go off of percent of credit sales. We can look at all the credit sales we've had in the year and just say 2% is uncollectible. We calculate 2% and we write it off to bad debt. Debit bad debt expense, credit allowance for doubtful accounts. It's easy, right? It's really easy. Or we can do an analysis of receivables. That's more common and a little bit more accurate because you're dealing with credit sales. There may be, as we make credit sales throughout the year, we're also getting that money back, right? So credit sales isn't really indicative of how much we're going to receive. But if we're looking at our actual receivables at the end of the year, and an analysis means we're looking at, well, how much is current? How much is due, 30 days past due? How much is 60 days past due? How much is 90 days past due? How much are we never going to see again? It's like, and this makes sense, right? The older a debt is, the less chance we're going to collect. Once you hit about the 120 point, 120 days, that's like 4 months, then you get 180. The chances of us getting that money at that point are very low. Okay? We could, it happens, but the chances decline over time. So doing an analysis, and then, the more current it is, the higher chance that we'll see money. That's what we're doing with an analysis. So again, if we use percent of sales method, it's pretty easy. It doesn't really matter what our balance in accounts receivable or our allowance for doubtful accounts is. It only matters what our total credit sales are, okay? So to do a percent of sales, if our total credit sales are $3 million, and we think 3/4% or 0.75%, I don't know why they can't just do 1%, right? It's uncollectible. We would truly take 3 million times 0.75%. And our estimated bad debt for that year, our adjusting entry is $22,500. Okay. So we would debit bad debt expense and credit allowance for doubtful accounts, $22,500. So percent of sales, we just truly take whatever percent they are saying is uncollectible. You'll never have to come up with the percentage. So we take credit sales times that percentage to find the amount. We debit bad debt expense and credit allowance for doubtful accounts. And I know we're running low on time. So we're pretty much almost through the receivables, so that's good. Almost through the allowance stuff. So I'm just going to show you real quickly what I mean. We're not going to go through all of this. I just kind of want to show you an aging of receivables account, what it looks like. So basically, an aging of receivables is our second method, which we'll pick up on Tuesday and talk about it. So you'll have a list of customers and what they owe us, bless you, and then it's broken down by how overdue it is. So for Brock Company, it's all current. So the percent uncollectible that they come up with is 2% of anything that's current debt. Okay. And then, as you see, we have $2,600 that's past the 180 days late. So we deem that 50% of that is uncollectible. So a company is going to decide this. They're going to come up with these percentages uncollectible. But you see they increase the older the debt becomes. If it's over a year old, we predict 80% of it's uncollectible. Might even be higher than that. But that's the company's coming up with that. So then we just calculate how much we think uncollectible will be based on all the different aging. But again, we'll look at that on Tuesday, and then we'll do the estimations on the analysis of accounts receivable on Tuesday, because it's a little trickier. And then we'll do notes. So Tuesday, we'll just kind of pick up right here. I'm gonna make a note where I left off. And so you really don't have anything to do over the weekend. You can get started on your chapter 8 homework if you want to, but nothing's due yet. So have a great weekend.
So nothing to do over the.
Yes, yeah.